Silver's December 31st, 2026. Explosion won't be a mood swing. It'll be a physical constraint, finally forcing the paper market to reprice in public. And the reason I'm saying that right now is because the comeback already started before most people even noticed it did. The public will see the candle, the headlines will scream mania, and the commentary class will call it irrational. But the hidden mechanism that matters is quieter, meaner, and way more mechanical than a story about sentiment. Because if one specific pressure point keeps building through this year, the year end won't be a celebration. It'll be a stress test. And by the time we get to that last week of December, the only question that will matter is simple. Do we still have real metal where the paper market pretends it does? At the exact moment, the calendar forces the biggest players to prove it. That's the payoff in this video. What actually powers the move, what level flips the setup, what would invalidate it, and what you watch in the next week or two to tell the difference between a controlled retest and a continuation squeeze that can gap when you least expect it. And here's the first uncomfortable truth. The spot price is often the last thing to tell you the truth. Right now, as we kick off 2026, silver has already shown you the character of this market in one brutal sequence. An historic 2025 surge, a year-end punch through the $80 handle, and then the kind of pullback that makes confident people question their own eyes. That whiplash isn't a bug, it's the feature. It's what happens when a market sits at the intersection of industrial necessity, macro stress, and leveraged paper positioning. And the moment a move goes vertical, the same playbook activates to smother participation. The bubble label, the "it's just speculation" narrative, the loud reminders about risk, the subtle tightening of conditions that make it harder to stay in the trade. Not because there's a shadowy villain in a back room, but because incentives are predictable. Dealers manage risk, funds manage volatility, clearinghouses manage exposure. And when a commodity turns into a headline, the system tries to calm it down by making it expensive to chase. But that's not the part that matters. The part that matters is what happens underneath the headline chart while everyone is arguing about whether silver deserves a price. Because the comeback didn't begin with a candle on a screen. It began when silver proved it could transition from being treated like a noisy sidekick to being treated like a strategic input. In 2025, silver didn't just rise, it re-rated. It wasn't only an investment trade anymore, it became a cross-market problem, a metal that sits inside solar supply chains, electronics, electrification, and defensive demand, while also sitting inside futures curves, options books, ETFs, and the leverage plumbing that turns a normal move into a forced one. That's why you had a year where silver could surge dramatically and still find bids. It wasn't just people getting excited. It was multiple categories of buyers showing up for different reasons at the same time. And when that happens, the market structure changes. The range widens, the stops get hunted, the air pockets appear, and the people who only watch spot get blindsided by the signal that was screaming in a different place. Here's the hidden detail that reframes the whole story. In silver, the curve can matter more than the price. If you only watch spot, you're watching the theater. If you watch the term structure, you're watching the cast change costumes backstage, because the curve tells you how badly the market wants metal now versus later. And that's where physical stress reveals itself before the spotlight hits it. In a normal commodity world, futures are usually above spot because carrying inventory costs money, storage, insurance, financing. That's contango. It's boring. It's the market saying, sure, we can deliver later, and it costs something to hold it until then. But when the curve flattens, and especially when it flips, when near-term prices become rich relative to later delivery, that's the market telling you something uncomfortable. Immediate supply is tight enough that people will pay up to get metal now rather than accept a promise. That's backwardation. And in silver, backwardation isn't just an academic term, it's a flare gun. Now, I'm not going to pretend we can reduce a global metal into one neat indicator. You can't. But the curve is powerful because it translates pressure into math, and math forces behavior. If the nearby contracts are rich relative to the deferred, it creates incentives to pull supply forward, to source metal, to borrow metal, to unwind inventories, to do anything to meet near-term needs. And if enough participants do that at once, the paper price has to reconcile with the physical chain because someone has to deliver something to someone, somewhere, at a specific time. And that's where the real pressure starts. This is also where the paper versus physical misunderstanding traps people. Paper silver is easy. It's infinite in the sense that you can create more exposure with a keystroke. Futures, options, swaps, synthetic positions, exposure can expand or contract fast. Physical deliverable silver is not infinite. It's constrained by mining, refining, recycling, and logistics. And silver has a particularly stubborn constraint that people love to ignore. A significant chunk of supply is produced as a byproduct of other mining. That matters because even if silver's price rises, it doesn't automatically trigger a proportional surge in supply the way a primary produced commodity might. The lever is slower. The lead time is longer. Refining capacity is not a light switch. Recycling has limits. And industrial demand doesn't ask permission. It shows up as purchase orders. So picture the structure like this. The paper market is the price discovery megaphone. The physical market is the delivery reality check. Most of the time, they coexist without drama. But when physical tightness rises, the stress first appears in places the average investor doesn't watch. The spread between months, the cost to borrow metal, the premiums in certain channels, the availability of size, the way merchants behave when they stop offering you metal for normal terms. This isn't a conspiracy story. It's the story of incentives when scarcity appears. When there's plenty, sellers compete. When it's tight, sellers ration. And rationing doesn't announce itself with a press release. It shows up as we're back ordered, delivery times shifted, that size is unavailable, premium is higher, we can't commit. And those little frictions are exactly what turns an overbought chart into a market that can stay overbought longer than anyone thinks. Now let's talk inventory, because this is where people get tricked with the wrong numbers. Not all inventory is created equal. In exchange-related warehouse systems, there are categories. Metal that is deliverable against a contract versus metal that is merely stored but not committed for delivery. The names differ across reporting, but the concept is the same. One pile is ready and registered for delivery. The other pile is present but not necessarily available for delivery without a decision. And that difference matters enormously during delivery windows, because when stress hits, total inventory can look stable while the deliverable category tightens. That's when confidence gets fragile. That's when spreads start to behave differently. That's when the nearby contract becomes the battlefield. And that's when you can get a price move that feels like it came out of nowhere, because the catalyst wasn't a new story. It was a new constraint. This is why the date in your title matters so much. December 31st is not just a date on a calendar. It's a mechanical deadline for a huge part of the market. Year-end forces mark-to-market reality. It forces risk books to show clean exposures. It forces funds to rebalance. It forces dealers to reduce certain risks. It forces investors who have been sitting on gains to either lock them in or defend them. It forces the reporting of positions. It forces the rolling of exposures. And it often lands in the thinnest liquidity of the year. That combination is dangerous, not because it creates demand out of thin air, but because it concentrates decision-making into a period where the market's ability to absorb those decisions is at its weakest. Thin liquidity doesn't just mean fewer traders. It means every trade leaves a bigger footprint. It means stops trigger faster. It means gaps happen. It means price discovery becomes jumpy. And in a leveraged commodity, jumpy price discovery is the spark that lights forced behavior. And forced behavior is the engine behind the explosion concept. Because markets don't go vertical when everyone politely agrees. They go vertical when someone is forced to buy. And there are two primary ways that happens in silver at the worst possible time. Options, reflexivity, and short cover margin spirals. Let's unpack both cleanly, because this is where most videos get sloppy. Start with options reflexivity. Dealer hedging, delta, gamma, the whole machine. When a lot of call options exist at certain strike levels, dealers who sold those calls will typically hedge their exposure by buying the underlying as price rises. The higher the price goes, the more they need to buy to stay hedged. And the closer the price gets to those strikes, especially when the options are near expiration, the sensitivity of that hedge can increase. That's gamma. It's not a moral story. It's not manipulation. It's a risk management equation. And the equation doesn't care if the chart looks stretched. If price enters a strike zone with heavy open interest and the market is illiquid, hedging flows can accelerate the move, which then forces more hedging, which accelerates again. That's the reflexive loop. And once it starts, it can run farther than fundamentals can justify in the short term, because the driver isn't fundamentals in that moment. It's positioning mechanics meeting a calendar. Now, the second engine, short cover margin spirals. Shorts don't lose because they are philosophically wrong. Shorts lose when the margin math stops cooperating. In futures, you post margin, you mark to market daily, and when price rises fast, your account balance drops fast. If volatility rises, margin requirements can rise too. If you're leveraged, those two forces squeeze you at the same time. Price against you and collateral demanded from you. If you can't meet it, you reduce. And reducing a short means buying back what you sold. That's covering. And if multiple shorts cover into a thin market, you can get a melt-up that looks like insanity, but it's actually liquidation. That's the next detail that flips the whole setup. Year-end is when risk managers are least tolerant of ugly exposures, and thin liquidity is when ugly exposures become impossible to manage without moving the price. So, when you combine those engines with the underlying physical constraints, you get the shape of a year-end explosion. The curve tightens, the nearby contract gets bid, physical frictions rise, Option strikes become magnets, shorts feel the vice, dealers hedge, liquidity thins, and price jumps in steps instead of smooth climbs. And the explanation the public hears will be the least relevant part of the move. They'll say it was a tweet. They'll say it was a headline. They'll say it was speculators. But if you've been watching the structure, you'll know it was building for weeks. This is also where global arbitrage becomes the quiet puppet master. Silver is a global chain of prices. If one region becomes tight, premiums can rise and metal flows respond, but they do so with delay and friction. Moving silver isn't like moving a digital asset. You have refining standards, bar sizes, assay requirements, transportation, financing, insurance, and time. When one hub offers a higher effective price for deliverable metal, it pulls metal from elsewhere, but that pull is not instant. The lag creates the window where paper prices can be behind reality. And when arbitrage becomes constrained by time and logistics, the nearby futures can behave like a pressure gauge. The harder the physical pull, the louder the curve can scream. And when that scream meets a thin tape, you get the move everyone pretends was unpredictable. Let's stack the proof, because you never want to rely on one argument in a market this violent. You want a stack that can survive skepticism. Proof point 1 is the term structure itself. A curve that refuses to behave normally, nearby strength that persists, spreads that don't relax even after pullbacks. Proof point 2 is deliverable sensitivity, not total inventory headlines, but the behavior of the categories that matter into delivery windows, and whether the market treats deliverable ounces like they're scarce even when total stock looks fine. Proof point 3 is borrowing stress, the kind of conditions where the cost to source metal for immediate needs rises and doesn't normalize quickly. Proof point 4 is on-the-ground symptom, premiums, availability, procurement behavior, and the way merchants ration when they sense demand that can't be satisfied smoothly. Proof point 5 is cross-market comparison, whether other precious metals and related risk signals confirm the macro backdrop, rates expectations, currency stress, geopolitical tension, the broader bid for hard assets. Proof point 6 is positioning and volatility signature, the kind of price action that tells you forced flows are present, fast up moves, sharp down moves, gaps, and then stubborn recoveries. When you see all of that in one market, you stop asking, why is silver doing this? And you start asking, who is forced to do what next? And because your audience is skeptical, and they should be, we also have to address the counterpoints aggressively before they blindside you. The skeptic case says, silver is a volatility trap. These moves are unstable, positioning is crowded, and a single macro shift can smash it. That's not wrong. Silver can be brutally mean even when the bullish thesis is correct. If rates surprise higher, if the dollar surges, if liquidity tightens, if risk-off turns into forced selling across assets, silver can dump hard. And even in a bull market, it can do it repeatedly. That's why anyone selling you guaranteed outcomes in silver is selling you a fantasy. But here's the nuance the skeptic often misses. Volatility doesn't disprove structural tightness. Volatility is often the mechanism through which the market rations demand and transfers metal from weak hands to strong hands. In other words, the pain is part of the process. Now, we bring this back to the title, the story behind the comeback, and we frame it in a way that respects time. We are not pretending it's December 31st, 2026 today. We are saying the setup that could produce that kind of year-end explosion is already visible right now, early in 2026, in the way silver behaved into year-end 2025, and in the way the market is being forced to reprice what silver is. We have a metal that just posted an historic year, touched a psychologically explosive level above $80, and then settled back into the low to mid 70s. That matters because it means the market has accepted a higher regime while still carrying the scars of violent pullbacks. It means the ceiling has been tested. It means the public has been conditioned to expect whipsaws. And that conditioning is exactly what the market uses to shake people out before the next leg. But that's not the part that matters. The part that matters is whether the structural bid remains underneath, and the cleanest way to judge that is not by your emotions. It's by what the market structure does after the adrenaline fades. So what do you watch this week and the next if you're trying to detect whether the comeback is intact? You watch whether the pullbacks hold above a shelf in the low 70s, because that area is where buyers showed up after the year-end fireworks. You watch whether the market can reclaim the high 70s without collapsing, because that's where the next set of option strikes and psychological resistance tends to cluster. And you watch the low 80s zone like it's a fault line, because once the market has already proven it can trade there, it becomes a magnet in any renewed squeeze. You're not forecasting a straight line. You're mapping pressure zones. And if one specific level breaks with volume and the curve refuses to loosen, the math changes. Here's how the math changes. If silver stabilizes after a big move and the curve stays firm, meaning the market continues to value near-term metal, then sellers of calls and shorts have a problem. Time is no longer their friend. Because every day that passes without a breakdown forces them to carry risk into the next calendar trigger. Monthly rebalancing, options expiry, delivery windows, quarter end, and then the monster trigger, year end. And year end is where you can get that December 31st explosion dynamic, because it's where the willingness to carry ugly exposures goes to die. Funds want clean books. Dealers want reduced gamma risk. Risk committees want fewer surprises. And the market's ability to absorb flows is thinner. That's when forced buying becomes a headline. That's when the move looks like a miracle. But it's math. Now let's talk about industrial demand. Because it's easy to overhype it and just as easy to dismiss it. The real point is not solar equals moonshot. The real point is procurement behavior. Industrial buyers don't operate on your chart time frame. They operate on supply security. They care about delivery certainty. They care about contract stability. And when they sense uncertainty, whether from policy, supply chain constraints, or elevated volatility, they often pull forward purchases. They build buffers. They diversify sourcing. They lock in. That behavior can tighten the near-term market even if overall annual supply demand looks balanced on paper. And when industrial procurement meets investment demand and macro hedging demand, the near-term stress becomes more likely. That's the intersection where a paper market can be forced to catch up to a physical chain. You also have the institutional framing layer. When a metal is treated as strategically important, whether through critical mineral designations, policy language, or supply risk rhetoric, it changes how both investors and industrial participants behave. It doesn't guarantee higher prices. It changes the risk distribution. It makes being short more dangerous during stress. It makes the demand for secure supply more urgent. It makes the narrative less about speculation and more about security. And that shift matters because narratives influence flows. Flows influence structure. Structure influences price. Now, you need the viewer psychology shield because this is where the market steals money from smart people. Silver will try to manipulate you emotionally through volatility. It will spike, make you feel late, make you chase. Then it will dump, make you feel stupid, make you sell. Then it will grind, make you feel bored, make you leave. Then it will spike again without you. That cycle is not accidental. It's the natural output of a leveraged market with thin liquidity at key moments and a mix of participants with different time horizons. The shield is simple. Separate trend signal from noise. Trend signal is structure. Higher highs and higher lows on meaningful time frames, persistent support shelves, and market structure indicators that don't normalize even after pullbacks. Noise is the intraday violence, the wick hunts, the headlines, the one-day panics. You don't have to be a robot. You just need pre-committed rules. You need position sizing that can survive a whip. You need a clear invalidation point that's based on structure, not emotion. And you need to accept that in silver you can be right and still experience pain on the way. So here's the practical near-term roadmap, what comes next, and how you tell which scenario we're in. Scenario 1 is the controlled pullback and retest. In that scenario, silver cools off from the year-end surge, dips into the low 70s region, maybe even tests a deeper level briefly, but buyers show up. The key is not the dip. The key is the response. Does the market recover quickly? Does it hold above a higher floor than it held before the surge? Do the rebounds come with real volume? Does the curve stay firm? If yes, the comeback remains intact. In that case, the market is building a base for the next attempt at the highs. And the next catalyst becomes a calendar 1. Options windows, month-end flows, and eventually the march toward year-end 2026, where the biggest pressures concentrate. Scenario 2 is the continuation, squeeze, and gap risk. In that scenario, the pullbacks are shallow. The market refuses to give clean re-entry. Every dip is bought faster than expected. The high 70s zone becomes less of a ceiling and more of a trampoline. And then you see it, the pushback toward the low 80s zone with speed. That's the setup where options hedging can intensify again, shorts can be forced again, and price can gap when liquidity thins, especially around weekends, holidays, and major roll windows. In that scenario, the danger is not being wrong. The danger is being underprepared for velocity. Because when silver goes, it doesn't send invitations. Now, what weakens or invalidates the thesis? This is where credibility lives. If silver breaks down through structural support and fails to reclaim it, meaning it doesn't just wick below, but actually spends time below and rallies get sold, then the comeback is at risk. If the curve loosens materially, meaning the nearby tightness relaxes, spreads normalize, and the market stops valuing immediate metal, then the physical pressure narrative weakens. If macro conditions shift aggressively against metals, if real rates surge, if the dollar spikes in a sustained way, if liquidity tightens hard, then silver can retrace brutally, even if long-term demand remains. And if you see broad force selling across assets that drags commodities with it, silver can become collateral damage. None of that means the story is over. It means the timeline changes. And timeline is everything in a trade built around calendar triggers. Now, let's pull the camera back to the real promise of the title. The December 31st, 2026 explosion is not about predicting a number. It's about understanding the type of market that produces that kind of move. It's a market where physical constraints quietly veto paper assumptions. It's a market where the curve tells the truth before the price does. It's a market where inventory categories matter more than inventory headlines. It's a market where global arbitrage is slowed by logistics, making near-term pressure more meaningful. It's a market where options and shorts can be forced into buying at the worst possible time. And it's a market where the calendar doesn't just mark time, it forces decisions. If you understand that, you stop being surprised by the violence. You stop needing every move to be explained by a headline. You start watching the mechanisms, and that's the comeback story in one line. Silver isn't coming back because people suddenly like it. It's coming back because the world is asking it to do more work, while the supply chain can't respond quickly, and the paper market has to periodically reconcile its promises with delivery reality, especially at the moments the calendar concentrates risk. That's why the move can look suppressed, then suddenly explode. It's not one continuous fight. It's a series of pressure builds and releases, and the releases often happen when the market is least able to absorb them: thin liquidity, heavy positioning, and forced deadlines. Because if this one level breaks, the math changes. So what should you do with this right now without turning it into hype? You build a watch list of signals that keep you honest. First, watch the shelf. Does silver keep finding buyers in the low 70s after shocks, or does it bleed below and fail to reclaim? Second, watch the trigger zone. Does the market reclaim the high 70s and hold, or does it reject and roll? Third, watch the magnet. Any credible retest of the low 80s zone should be treated as a volatility event, not a victory lap. Fourth, watch the curve behavior. Is the near-term market still tight, or is it relaxing? Fifth, watch the calendar. Month-end, option expiry, delivery windows, and the thin liquidity holiday periods are where the paper market is most likely to be forced to show its work. And finally, watch yourself. Because the market's favorite trick is making you trade your emotions instead of your plan. One more point that most people miss. Volatility will be used against you even when you're on the correct side of the long-term setup. The market will try to convince you the thesis failed, not by disproving it, but by making it painful. It will show you a red candle so large you think something broke. It will make you distrust your own logic. That's why you separate signal from noise. That's why you size positions, so you can survive the noise. And that's why you keep a two-scenario lens at all times. Controlled retest versus continuation squeeze. Both are normal. Both can happen inside the same week. The difference is the structure. The difference is whether support holds. The difference is whether tightness signals persist. The difference is whether forced behavior is building again. And here's the subtle truth that makes the whole thing click. If the comeback is real, it won't feel comfortable. It will feel like a series of tests. Tests of conviction, tests of liquidity, tests of market plumbing. The public will be invited in at the worst moments and then punished for showing up. That's how high volatility commodities transfer risk. The people who survive are not the people with the hottest take. They're the people with the cleanest process. The ones who know what matters, what doesn't, and what to watch next. So if you want to frame this like a professional instead of a tourist, say it like this. Silver is a market where structure leads price, and the calendar can turn structure into a headline. The December 31st, 2026. Explosion is the kind of outcome you get when near-term tightness, global procurement pressure, and leveraged positioning collide with thin liquidity and year-end risk constraints. That doesn't mean it must happen. It means you can see the conditions that would make it possible. And that's the edge, because most people won't look until the candle is already on their screen. If you're the kind of investor who wants logic over noise, drop in the comments the one signal you're going to watch this week: spreads and term structure, deliverable inventory behavior, option strike zones, or physical premiums and availability. Because the community that survives silver is the one that compares notes on mechanisms, not feelings. And as we move through this year, remember the rule that keeps you sane. Price can whip violently even if the thesis is correct. And the goal is not to predict every tick. It's to stay aligned with the structure while the crowd gets shaken out by the noise.